Good afternoon, ladies and gentlemen, and welcome to the Fulham Shore Interim Results Investor Presentation. And apologies for the late running of this presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your investment company dashboard and will notify you by email when these are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, I'd like to submit the following poll. And now I'd like to hand you over to Chairman David Page. Good afternoon.
Good afternoon, and thanks for having us, as they say. Hello, everybody. We brought out our half-year results this morning, which showed increases in turnover and profit for the two restaurant businesses that we own. And this is a presentation describing how we achieved those numbers. And so to introduce the company, we have founded this concern in 2012, so nearly 10 years ago now. And we have currently 57 pizzeria and 21 Greek restaurants. We were looking for business models that combined good food, and we could maintain the quality of the food while we expanded, and also a value price point of between £10 and £16 a head, which we feel is defensible in any economic downturn. We feel that in economic downturns historically that more expensive restaurants have found it very difficult. So next slide, please, which I think is Nick Wong will talk about.
So we announced our half-year results to 26th of September 2021 today. To start with, it's important to remember that out of the 26 weeks of trading, we only had 10 weeks without COVID restrictions. Just a reminder, right at the beginning of the financial year, we had 2 weeks of full lockdown, and then we were allowed to open for dining in and outdoor seating, then socially distanced indoors from mid-May, and then no restrictions from July. So it has been a very different 6 months for us. However, during this time, both our businesses have performed significantly better than the 2019 similar half year, which was pre-pandemic. So both businesses saw their revenue, headline EBITDA, and PBT ahead of the comparable numbers. In the table below, we show you some of these key numbers. So for instance, revenues has increased by 10% against the 2019 numbers. Our headline EBITDA has been ahead, which is our numbers including the IFRS 16 lease accounting. And the number that most analysts use at the moment is our adjusted headline EBITDA, which is effectively the number with the rents included, so excluding the IFRS 16 accounting. So we increased that from 5 million in 2019 to 6.9 million in this 6 months. And most of the other numbers have been positive down the income statement. Our operating cash flow for the 6 months came in at 15.6 million, a significant improvement on the 9.4 in September 2019. And a lot of this has been driven by the trading that we've seen throughout this period, significant uplift that we saw, particularly in the Real Greek as well, where it benefits from a lot of outside seating. And of course, with the reopening of dining in, we saw a lot of our customers come through wanting to sit outside and significantly benefit the Greek. We closed the half year with net cash of 5.1 million. And that's a significant swing from the beginning of the financial year. And we'll go on to that on the next slide. During this time, our we saw our cash generation in this period improve significantly, and we had enough cash to repay our Clivo loan back in November. This has allowed us to open our new restaurants and to incur the capital expenditure as we believe suitable. Because previously, with the government-backed loan, we were restricted from some of our opening programs. And on repayment of that loan, we have increased our RCF facility from 14.25 million to 17 million and extended it out to 3 years. So we now have a 3-year commitment from HSBC on that facility. And combining that with our overdraft of 0.75 and the cash that we have today of 5.1 million, that gives us a headroom, financial headroom, of more than 20 million pounds to support our opening program. However, our plans are still very much focused on delivering our opening program from our internally generated cash flow. So with our openings, which we mentioned today, looking to open 17 to 18 restaurants, we'll be looking to fund that from our operating cash flows. Just to cover off covenants, we do have some covenant tests in place for the RCF facility. And these are pre-IFRS 16 numbers in the tests. And for the 6 months to September 2021, we had significant headroom on all of the covenants, whether it's debt over EBITDA, our fixed charge cover, or our interest cover. There's significant headroom to help us fund our opening program. Next slide, please.
Oh, we've skipped one or two. Oh, maybe we haven't. Okay, sorry. Next slide, but one. Yeah, the operational review. Francomanca, we've got 57 Francomancas at the moment, one in build, and we keep getting awards because if we think we're the best pizza operator in terms of quality and price in the UK market. We have grown the business from 11 sites to 57 in 6 years, and as I say, we get awards every year. Our customers love our dips, and we're selling £1 million worth of dips every year, selling well over 100,000 pizzas a week. The last 2 or 3 weeks, we've had record weeks in terms of volumes in our restaurants. And the big change over the last 18 months, of course, is the change in people's working habits. And we have a geographically spread estate that goes from commuter suburbs to towns outside London and coastal towns and big cities. And this has fared us very well because whatever trade we have lost in the city centres and West End and theatre districts over the last 18 months, we've more than made up for in the commuter towns and the cities outside London. As I said, we're building one more Francomanca at the moment in Bishop's Stortford, but with 3 more building projects ready to start in January. We've also signed our first franchise abroad in Greece, and he is currently building a restaurant to open there next week, actually. And then he's got another site he's signed up already in a different suburb of Athens, north of the centre. Next slide, please. With Francomanca, we have an app that is incredibly popular with our customers, and we've put on 160,000 customers since the pandemic started. And we encourage people to download the app by effectively giving them 1 free pizza after they purchase 6. And in fact, we're trying to migrate our takeaway customers back into the restaurants because you can only use it when you dine in. So we're in this way attempting to change customers' habits to come back into dine in from delivery, which they had over the pandemic, and that seems to be working. We had a queuing system which helped us enormously during the pandemic because it followed government guidelines about monitoring our customers, and that would be put back into use if the government ever insist on that again as part of any of their policies controlling COVID. We've got a single customer review system which allows us to know our customer better. We can push promotions to people who like our business, and we also, on new openings, can encourage people to come in right from the beginning, because we have on our hoardings outside, when we're building a project for 10 weeks, we have a quick reader where people can actually join and get some benefits from joining our club of 270,000 people. We also use it because we can tell when people have stopped visiting us and ask them politely why they haven't, and give them this encouragement, usually financial, to rejoin us. Next slide, please, which is the real Greek. We had this business and bought it when it was 6 strong, and it's now 21. The food is sharing plates, small dishes. We have developed it with a lady called Tonya Buxton, who is on TV as the face of Greek cuisine in the UK. And we currently have 21 restaurants. We're building another one which opens at the end of this week in Manchester. So we'll have 22 by Christmas. And we think the UK can cope with 50 of these restaurants in London and throughout the UK. We're looking in, we're building actually the second one in Manchester starting in January, and we're looking in places like Newcastle, Edinburgh, Liverpool, and Glasgow. It's had the Greek had a really good summer. It usually has a good summer because people love Greek food when it gets warmer. It wasn't too warm this summer, but during COVID, we'd covered all the terraces to get the benefit of the government regulations that said people could only eat outside. So we were well prepared for this summer in the Greek, and that's why it had a great performance in the 6 months. It also had a pretty poor 2019 because we didn't have covered terraces then, and the summer was pretty poor. So it's bounced back from a weather affected 2019 and a COVID affected 2020, and it really hit the ground running this summer, and it was back to its normal performances and more. We also started a grocery web shop for the Greek products earlier this year, which provides a little bit of extra income. Next slide, please. I mentioned before that we've opened in Greece, so we're going to open in Greece next week. That franchise agreement is for opening 6 restaurants over 3 years. In franchising abroad, which both Nick and I have done before, we look for experienced operators, ideally. We agree an opening program with them, and we get some cash for the territory fee up front, and then they pay us a fee for opening each restaurant. That would be the ideal scenario. On top of that, they pay a percentage fee on the turnover that they get as a result of taking our brand. We have had successes before in overseas franchising, but financially you have to open at least 5 sites abroad and get the franchise fee to equate to 1 contribution from 1 UK site. So it's going to take some time before we build up a head of steam abroad to affect our figures in Fulham Shore. But we're laying down the foundations now for the years to come. And Greece is a relatively small territory. We probably not opened more than 20 in Greece over the years. And the big territories we'd be looking for would be France, Spain, and Germany in Europe, and possibly Japan, Indonesia, and America. It's got to be somewhere with a sufficient population that we can repeat the success of what we are doing in the UK, i.e. 150 or 200 restaurants in each brand. And we're talking to various people in the Gulf and around the Mediterranean to build on our Greek agreement. Next slide, please. In the UK, the well-publicised problems of landlords are continuing. And we think it's very similar to 93 to 99, where the property market was in disarray and many expansion opportunities for restaurants, which was the first stage of the restaurant expansion in the UK. Once in those days and now, rents are far below their height, which I would say they reached in 2018. Premiums on sites have almost disappeared. And landlord contributions and rent frees are readily available. I mean, we quote the site below for the Real Greek, which we opened a restaurant for nothing effectively, because it was a restaurant before. The landlord gave us some money to refurb the existing restaurant, and which equated to about the same amount of money that it took to refurb. So it was a nil game as far as we were concerned for cash out. And it immediately started taking 30 to 40,000 pounds a week. So obviously it was very profitable straight away. And the landlord, although the landlord helped us, which looks like our benefit, he is actually getting a percentage rent from us. So because we're doing such good turnovers, he will actually do quite well out of this site for his help in us opening. If we were talking to you a year or 18 months ago, we'd be telling you that capital costs per site had gone down, but they've now come back to 2019 levels because of the increase in labour costs for the builders and product costs and material costs and electricians and carpenters. So that we're now back to where we were a couple of years ago in terms of the costs for the two different businesses to open a store, but our return on capital is still over 30% on average, and so we're still saying and achieving 3-year paybacks on the money we invest in a restaurant. As I've said before, if you take over an existing restaurant, you spend a little bit less to refurbish it because you've already got the loos and the utilities and the extract there. And if you take over a bank or a shop, well, it's a shell, so that actually costs more than the average. And we hope to expand these two businesses to reach at least 100 restaurants by March 2023, just over 15 months' time. Next slide, please. Nick, would you like to come in, as I've been talking for a bit?
Yes, of course. Just cover off current trading and outlook. All our restaurants are obviously open now, post-COVID lockdowns. Since the half year, we've now opened 2 more Francomancas, one in Blackheath and one in Baker Street in London. We've also opened the Real Greek in Bluewater, and as David mentioned, we have one in Manchester in Corn Exchange that's about to open this week. And we're building Francomanca in Bishop Stortford as well. We have a lot of property opportunities in the short term, and with that, we've got 21 potential sites in solicitors' hands right now in negotiations. And that will help us achieve our target of 17 to 18 new restaurants in our next financial year to March 2023. Next slide, please. And as mentioned before, we've repaid our Clivo loan, so the government support is now been removed. We've got a new 3-year RCF facility of £17 million to support our openings. We've got net cash as of the weekend of 5.1 million. And of course, together combined, we're now very well. We've got a significant headroom of £20 million. trading continues to be very strong in both brands. In October, November, and now December, we're still seeing both brands trade ahead of the 2019 numbers. We're now opening restaurants internationally through our franchising. And as a well-funded group, we're now looking at the dividend policy, and we'll be letting shareholders know in due course of our plans on the dividend policy. Of course, the board is now very enthusiastic, and we're very much committed to our opening and our growth strategy for the next 3 years.
And then we've got another slide where Mr. Wong can talk through the financial. Oh, sorry. We've got these sort of I've got my slides out of sync here. We've got a team which needs to be motivated, and a lot of our employees are shareholders. Last time we looked, were 50% of our staff own shares. We have share option schemes, and we have bonuses, long-term and short-term cash incentives, and we're always looking for ways to keep the best people. I mean, the bottom line, of course, is you've got to pay better, and we put our wages up for back of house in August and September, and that effectively cured any staff shortages we had at that time. But we have other wrinkles in the business in that the delivery and takeout obviously doesn't attract tips. So the chefs were working very hard making pizzas, for instance, in Francomanca for our customers who wanted to use that platform. So we had to invent a scheme to incentivize them separately. So we're always looking for schemes to retain and reward the best people in the industry. Next slide, please. Here's the Mr. Wong slide that explains the various comparables.
So in this appendix, we have a reconciliation of the two key measures. One is headline EBITDA, which is as I mentioned before, the IFRS 16 included number, and the adjusted headline EBITDA, which is the old-fashioned more sort of UK GAAP style post-rent EBITDA number. And this is a reconciliation back to our PBT. So I think this concludes our presentation.
David, Nick, that is perfect. Thank you very much for your presentation today. Ladies and gentlemen, please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions already submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be automatically redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. David, Nick, investors have submitted a number of questions during today's presentation, and I wanted to hand back to you to respond to those where it is appropriate to do so. If you don't mind, please could you read out the question and say who it is from?
We've got Michael D, who's asked quite a lot of questions, so we can go through Michael's questions first, as it's only polite, given that he's quite keen. So the question is, what do you see as the perfect split in the store numbers going forward between Francomanca and Real Greek for the growth of the company? And what criteria do you look for in new locations? Well, this has changed since Brexit and COVID in that planners and landlords effectively had locked restaurants out of town centres before the retail collapse. So the whole landscape for opening restaurants has changed in the last 3 or 4 years. And for instance, in Kingston High Street, what's known as Clarence Street, you're going to get people in Kingston are going to get a new Wasabi, Leon, Francomanca. So the city centres are being repopulated with life, whereas for the last 20 or 30 years, Philip Green and the planners have conspired to make them deserts, wind like tumbleweed. So anyway, so restaurants are re-establishing themselves within the hearts of our towns, which is sort of a good thing that has come from the retail, the only good thing that's come from the retail collapse. And what do we look for? We look for really good rent. We look for a corner site if possible. And the balance between Frank and Manca and the Real Greek will be reactionary, really. We're reacting to events as to what comes available. Frank and Manca can open in 2,000 square feet or less, actually, whereas the Greek probably needs 2,000 or 3,000 square feet. So there are a number of small opportunities, small locations in the UK that Frank and Manca are suitable for, and the Real Greek actually probably less locations because they need slightly bigger sites, and they proved recently that need outside terraces. So that's that question. And then we've got a question from Matt. Michael's got a couple more questions, but I'll go to Matt now. Have we noticed any slowdown in sales post the appearance of last Friday's Omicron strain? No. Okay, we're coming up to Christmas, but as we have said that record weeks have followed record weeks recently, so I don't know. No is the answer. And then Michael was asked the second question: how difficult is it to find new staff, chefs and staff for your venues? It was in August until we put the wages up, and now we're attracting people from our competitors, and we are attracting people back that have left us. We're attracting new entrants to the sector that haven't ever worked in a restaurant before. And I'm afraid to say, there was an article on Radio 4 today in the morning. We're paying a lot more than care workers. So we are attracting people from other walks of life who are being paid less, so they can earn more money with us. So it was specifically mentioned that our sector was now paying more than care workers, which is not a very good thing. Carl asks, what are the metrics which will drive the dividend policy? We'll decide on our dividend policy and the amount, given we're currently considering it, when we're nearer the year end. So we know how the year end is going to turn out. So it'll be a few weeks before the year end where we're pretty sure what we're going to do. And then we'll know what the dividend should be. And at the start, it will probably be nominal, because we want, if we install one, we'll want it to be growing. So we don't want to start off and then go down. So it will be a progressive dividend policy. So we will start off on what we can afford and then monitor it going forward, and it'll be a proportion of what cash we throw off. And that's about it, I think, for the questions.
David, that's perfect. I think you've addressed all those questions from investors today. And of course, the company will review all questions submitted by investors today and will publish those answered on the Investor Meet Company platform. David and Nick, perhaps I could hand back to you just for a few closing comments.
Yes, our sales are pretty extraordinary, really. I think that both businesses are doing very well. We have probably a great demand rather than supply. We've got a problem with supply. We should open restaurants as quickly as we possibly can to feed the public's demand for our two businesses, which is what we're trying to do. But we can only accelerate at a certain speed. The properties take a long time to find and then open. But we're trying to accelerate the opening program to effectively feed the demand for our two businesses. We've got cash in the bank. We've got a great bank loan, RCF, and we're throwing off enough cash in the business now that we may not need all or any of our bank loan. So we're in a very good place. And thank you all for listening to us.
That's perfect, David. Thank you for updating investors today. Could I please ask investors not to close this session, as you'll now automatically be redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of the Fulham Shore, we would like to thank you for attending today's presentation. That now concludes today's session. Good afternoon to you all.